All right, good afternoon, everybody, and welcome to day three of Topstep Trading Strategies. Our main focus today is going to be on the market profile. Just a couple of notes here. If you do have questions, go ahead and put them in the Q&A section. It's easier for our helpers here, Jack and John, to be able to distinguish the questions versus the comments. As always, all your comments are welcome. All your questions are welcome. Good afternoon, Jack. Good afternoon, John. How's everything going?
Everything's just going fine over here. How about yourself, Hoag?
Doing well, doing well. Looking forward to today's session. As we I think all know, my savior in this business has been the market profile, and I always like to try and help people understand a little bit of how it works. It's a lifelong study, just like anything in trading, but I do look forward to these sessions. My name is John Hoagland. I'm the middle-aged performance coach here at Topstep. I do have more than 38 years of industry experience, 30 years actively trading after trading on the Chicago Mercantile Exchange floor for 20 years and migrating to screen trading in 2009, hooking up with Topstep in 2011. And it's been my pleasure to have the opportunity to talk to and hopefully help thousands of traders from all over the world. So you're going to jump right into things here. We ran out of time a little bit yesterday, and we were going to talk at the end there about gaps. Gaps on the charts. Gaps are areas in the chart where price of a stock or another financial instrument moves sharply up or down with little or no trading in between. As a result, the assets chart shows a gap in normal price pattern. The enterprising trader can interpret and exploit these gaps for profit. That's from Investopedia. Gap analysis. Common gaps are just that. They're common. And I think it's important to point out the fact that most gaps, because we're basically 24/5 trading in futures, we don't see gaps that often. Maybe over the weekend we'll see a gap, but day to day we don't see that many gaps if we're looking at the extended trading hours. When I'm looking at gaps, I'm looking at gaps between regular trading hour sessions and regular trading hour sessions. So this would be kind of a situation where we'll find gaps, especially in range bound trade, that are usually filled relatively quickly. As a general rule, when we have a gap, so let's say this is the end of the day yesterday and this is the beginning of the regular trading hours today, in a range bound situation like this, we'll probably look for the opportunity to close the gap relatively early. Gaps that are not closed relatively early offer a different type of situation. In this case, this breakout gap, if this were yesterday and this were today and we couldn't fill this gap relatively early in the session, I would look to go in the direction of the gap, which would have me looking for longs. There's nothing that is going to work every time, and there's nothing that's never going to work. It's all in our ability to manage our risk. We had a good example today of a market that opened outside of the previous day's range. Well, let's take a brief look at it after we get to this. Okay, this is that breakaway gap we were talking about. We've got a rising triangle. The breakout above that without a gap close brings us to the point where we're going to be looking to buy weakness in continuation of the gap. Gap rules. We open with a gap. If we can't close the gap relatively early, I understand that's a subjective term. If we can't close the gap relatively early, we're going to be looking to go in the direction of the gap. It's the same thing as range bound trade. We fade the extremes. We break out of the range. Sometimes it's going to include a gap. If we can't close that gap, that is a sign of acceptance of higher price, and we need to scale our strategy towards the fact that there's a good probability that without a gap close, this market is going to continue to move to the upside. Now for today, here's the TPO chart. Maybe we should go with a 30-minute chart here just to start things off. There's the 730 bar. Here's the 830 bar. I'm going to put the volume profile on here. So the market opened and created a gap. In this case, when we're looking at the current market state, by and large, we're still range bound inside of last week's range. Last week's low is that purple line there. You're going to see this on the 30-minute chart as well. This is last week's low. The market opened, didn't leave the opening range at neither the high nor the low. Initially, it left it at the low of the session, came back, looked below, and rejected. The market has basically spent all day returning back into yesterday's range without reaching back into value. Okay. So this was a gap that ended up getting filled. Now we can see that value has moved lower. That's important information, and more of that information coming in the information we've got about the market profile. So when the market opens inside a previous day's area of value, so this is kind of an unusual day because we had that CPI number. But when we open inside value from the previous day, it makes me believe that I don't need to do anything right off the bat. The best trade location is going to come as the day goes on, proven here by the 730 bar reaching all the way down here, and then another opportunity all the way up here. So the early trade inside value without the gap gave us the opportunity to be patient, wait for better trade locations as the day goes on. Kind of an unusual day to be looking at that as kind of a gap or a lack of a gap. Okay, so again, when we're looking at gaps, it's important to realize that we're looking at regular trading hour days, regular trading hour sessions to create the ranges that create the gaps. Here's yesterday's regular trading hour range. We opened outside of it, possibly a bigger opportunity. Why? The market is out of balance from the previous session. The market is either going to drive away from that area of balance or drive back into that area of balance. So if you do want to make sure you're able to make note of these gaps, put your volume profile, even if you're not using the volume profile, I find it's useful to distinguish the difference between regular trading hours and extended trading hours. Why do I really only focus on the information in the regular trading hour sessions? Because in the regular trading hour session, all of the participants are available to affect the market. The volume is, of course, going to be much greater in the regular trading hours. Our other time frame, longer time frame, stronger hands traders aren't trading overnight. They're trading in the regular trading hour session. In the overnight, we're looking at weaker hands, smaller traders, retail traders, a lot of them. And there's information that's missing from the overnight information. Okay, gaps also create from time to time the opportunity. Let me see if I can find a good one here. The opportunity to see. Let me see if I can find another market that's been a little bit more fruitful for this. Okay. So the settlement on this day was here. It's the blue line. All night long, traders got short, got more short, got more short. These are the weaker hands traders. When the market opens at 720 in gold, If the short time frame traders who are all short don't get what they're looking for, which is continuation to the downside, they'll adjust that inventory and bring price right up back towards where the inventory began, which is approximately right here. Where did the overnight inventory adjustment come back to? Right where it started. So it's important, again, to notice what the overnight inventory has done, because if you don't get a gap, if you open in range, especially inside value, and they don't see price continuing to pay them, they'll get nervous and they'll get out, and they get out en masse. It took an hour and a half for them to bring price back to where the overnight began, but they did it. This may not have been a tremendously large opportunity, but once the overnight shorts that are too short understand that they're not going to get help from the regular trading hour session, the overnight inventory is on. All right, so that's just a brief look at gaps, how I look at gaps, and I'm sure how many traders look at gaps. Just remember the simple rule: if you can't close the gap relatively early, it's marking acceptance of higher or lower price through time. Go with the gap. Okay. Market profile. The market profile seems complicated, I think, to a lot of folks, but it really isn't. It's just a different way to organize the information. The market profile is trademarked by the CBOT, so there's usually some sort of charge to add the market profile to many platforms. However, not all of them. My dad was a friend of the person or the persons who created the market profile. Pete Stottlemyre, I think, was really the innovator of it. And then Jim Dalton kind of expanded on the original text, which the original text is called Markets and Market Logic. Jim Dalton's first book is Mind Over Markets. I recommend both of them or one of them if you want to expand your knowledge on the market profile. It's just, again, a different way to organize the information that the market is providing for us in real time. It points out value and acceptance over time and rejection of price over time. Obviously, the market profile is based on bell curve theory, and shows the concentration of acceptance in time, again, and areas of rejection with little or no time. Now, there's a lot of nuances and a lot of features to the profile that take time to learn and then to digest into kind of secondary functions. When you're first looking at the market profile and you read about it and you learn about all the different features, date types, and nuances that come with the market profile, it seems a little bit daunting, but so did the first time you drove a car. The first time you drove a car, you had to think about every little thing that you did. There's the gas pedal. Where's the brake? Okay, there's the brake pedal. Which way do I turn the wheel if I want to go right, left? If I want to turn my right turn signal on, do I push the turn signal up or do I push the turn signal down? It's a piece by piece operation the first time you drive a car, and it's very similar to that when you start looking at the market profile. But the longer you drive a car and the longer you look at and learn about the market profile, the more it becomes easier to create those secondary functions. And by now, I'm sure you could drive to California without ever really thinking about how to operate a car. Market profile may never come to that ease for you because markets are always changing and the nuances have to be weighed in order of importance according to the current market state or context. So what I'd like to do, in what some of you have probably seen already, is, well, we're going to go through the the features and some of the vocabulary of the market profile, the very basics here, is the time price opportunity, the TPO chart. A lot of people call the market profile. The TPO is a time and a price where you had an opportunity to execute. Each of these little blocks or letters is called a TPO. Price got to that level, and you had an opportunity at a time to make an execution. The larger pieces of the profile, the basic is the TPO, the time price opportunity. The point of control is in a developing profile and in a finished profile is the widest line of TPOs horizontally that's closest to the center of the range. The point of control is considered the fairest price of the day. Now we've got this little red caret here showing the TPO point of control. Here we have this purple caret showing the volume point of control. This is the volume profile. This is the TPO profile. The volume profile is good. There are things about the market profile that will appear that do not appear in the volume profile. And a lot of those are some of the nuances that we're going to be talking about today. In time, in bell curve theory, there is an area of value, which is 70%, actually 68% of the total time in this area is spent inside the value area. So we have 15% of the time in this period spent above value. We have 15% of time spent below value, the value area low, the value area high. What we're looking at here is a system to take a variable, which is price, and then we're attaching it to a constant, which is time. The value area is where 70% of the trade has occurred as it relates to the point of control. The volume value area is here in blue. 70% of the volume in this session has occurred inside this value area as it relates to the point of control. The initial balance is the first hour of trade. On this platform, it's represented by this dark blue line. The initial balance is, some say, left over from the trading pits, because the locals in the trading pits would use the initial balance to try and find an area where two-sided trade can occur. And in this profile, this is basically almost all two-sided trade. I think you'll understand more as we move along. The opening range is this gold bar here, and a lot of trading platforms do not have the ability to represent an opening range. If you've seen on the forecast, when we watch the opening range in crude oil at 8 o'clock, we'll put on a 1-minute chart so we can gauge the size of the opening range. The opening range is an old pit term, but it still rings to be very valuable and true in certain situations. The opening range in the pit was when the bell rang, all the brokers in the pit were holding orders that were due fills right on the open. If it was slow, the opening range may be just a few ticks wide and only take 30 seconds to establish. In the pit, they would poll the brokers to make sure that the orders that they needed filled in the opening range, that the opening range would envelop those. On electronic trading, I think, I look at the opening range as the first minute. I think that's plenty of time for anybody that wants to get something done right on the open to get it done. We're pushing buttons here, folks. We're not screaming and hollering and waving at people and chasing them down to try and get our trades checked. Some say that the opening range is 30 seconds. Some say that the opening range is 5 minutes. I know people that look at the initial balance as the opening range. As long as you're consistent in your usage, you will find a use for it. Buying and selling tails. What we're looking for in buying and selling tails, we're looking for excess. We're looking for areas where price got too expensive, buyers wouldn't pay it anymore, and sellers quickly moved price back into range. A two-tick extreme, this two-tick extreme on the top of this profile represents a degree of excess, and it is considered a selling tail. This one little TPO sticking off the bottom here is not considered excess, and it is not a buying tail. It is more likely an unfinished downside auction. Okay, now, one of the nuances that we see in the profiles, and we saw one in the profile the day before yesterday that was eventually targeted to the downside in the S&Ps, and I'm going to show you that in just a couple of minutes here. Anomalies are anything that sticks out that doesn't seem to fit an even bell curve. If there's an eyesore, traders are going to notice it. And when they notice it, they focus on it. And when traders focus on something, they tend to make price go there. Example. Yeah, we'll use this. Okay. This was yesterday morning. The first thing that this market did early in the session after in the initial balance, this little anomaly right here, the market targeted this little anomaly, and it held as the low of the day until the last hour of trade. That little anomaly. What else did we see? More anomalies down here. Eventually the market did target those. So when there's an eyesore, when something doesn't fit, it would be considered an anomaly, and it gives you the opportunity to see price eventually go and check it. And anomalies do get checked quite often. Okay, so these unfinished poor highs and lows, poor or unfinished highs and lows, there's no degree of excess. What I'd like to do now is to put together a profile in real time-ish, okay? The market opens, and this is the opening range. A period, which is the first 30 minutes, the entire range of the first 30 minutes, each price that is traded is given one TPO. No matter how many times the market rotates through this range, only one TPO is given. The B period opens up. Okay, now let's take a look at a couple of things here. We've got our point of control just above the high of the opening range. At this point, the point of control is always going to be the center of the range. We know the point of control to be the widest line of TPOs closest to the center of the range. There's only one TPO wide. B period opens up, ranges up to here, and then extends the range lower, widening the initial balance and also moving the point of control lower. Value is developing at this time. 70% of the value or of the time has been spent between this price and this price. C period opens up, trades to even with the high of B, and takes out the low of A, and everything is pushed over to the left. The 30-minute period that represents C period is given one TPO no matter how many times price rotates back and forth. The time price opportunity. Time is the variable. Time is the constant. We've got to keep that time constant so we can see where the market is spending more time and less time. In D period opens up and takes out the high of B and C, leaves a little bit of excess at the high here in A period. The entire range is from here to here, And then we move on. We have A period. Well, we've got E period that trades all the way up here and moves the point of control higher now. The point of control initially moved lower. It's now moving higher because E period never completed the rotation and it took out the high of A. Okay, and so now we have excess at the bottom, too cheap. Buyers moved price quickly away from it. E period, F period comes in and moves point of control even higher. What's that telling us? Price is spending more time in the upper half of the profile than it is in the lower half of the profile. Does it seem like the market's going to head higher? Quite possibly. Now we get G period opens up, doesn't take out these highs, rotates all the way back down below value. The entire range is represented by one TPO per price, no matter how many rotations, and everything is pushed over to the left. H period. We come all the way back down and we take out the low of G period. We don't move point of control. Point of control is still higher. We have excess at the bottom, no excess at the top. This is that finished profile. When we had the weak high up here, the market continued to try and auction higher. With excess at the low, no excess at the high, point of control moving higher over time. It's an indication that buyers may be in control, but we still have to exercise good trade location. If we were making an assumption that the buyers were largely in control in this market, the market gave us 1, 2, 3 opportunities to buy this market close to the bottom of the day session range and below value. We buy below value with no range extension. 15% of the time has been spent down here. That gives us an 85% probability of having the ability to take a profit back inside value 85% of the time. That's if we don't extend the range lower, then it gives us that possibility. It doesn't say 85% of the time we're going to be able to sell it above value. It states if we don't extend the range lower, 85% of the time we'll be able to take a profit back inside value. This is where trade location and reward over risk become very important. If I'm risking 6 ticks here, I don't necessarily just want to take 6 ticks when it gets back into value. I'm looking at deeper than that. We get down here, well, we have a weak high here. That's likely to be revisited. We have excess at the low, so there's a good probability that may remain the low. Buying it down here with a weak high with point of control moving higher would give me the idea or the probability that says, you know, the buyers are in control here. If I get a long down here, it may be worth more than just back into value. Maybe I get an opportunity to sell the high of value. So it's not just buy it here and try and get the high of value. It's buy it here, excess at the low, weak high, point of control moving higher, then we get our opportunity. If I was to spread out this profile, because all of these TPOs range in 30-minute increments, what I'm looking at here is exactly the same information as the 30-minute chart. We see the A period open here. It'll trades lower, trades higher, and closes here. B period opens there and closes here, opens here, trades up here, trades down there, and closes here. The exact same information is provided when you split the profile. It just looks a little bit different when you crush the profile down to create the bell curve. It seems like we should be able to see everything when we're looking at a 30-minute chart, and yet we don't. When we're looking at the profile, what we're basically looking at is the diffusion of innovation. Your innovators are the first ones to adopt a new innovation. Think of the CD player. Okay, the innovators were the first ones to buy them back in 1982, and they paid a lot for them, but they paid a lot for the ability to use that innovation, that technology for a very long period of time. The innovators had the opportunity to enjoy them for the longest period of time. Then the early adopters bought into it. And then the early majority bought into it. The late majority bought into it. And if you bought a CD player right before everything went to MP3 or online, you got very little out of your purchase. When you look at this, we're looking at 16%, 16%. We're looking at 70%. We're looking at 68%. This is the value area. But the early adopters and the early majority can still profit. When we look at this, this is a rotational day. Okay, the market opened as the initial balance was established. We traded 4 ticks below. We traded 4 ticks above. This market was largely rotational. If I were a buyer, I would have to be an innovator only if I bought it on the lows. The early adopters still had opportunity in I period here to turn a profit. Early majority, you're getting more and more risk involved and less profit. The late majority, if you buy it up here, by the time you get it up here, you're the laggard. If you're buying C period up here or L period up here, you're not going to be enjoying that purchase for very long. However, the innovators would be the sellers up here in C period and in L period, because L period trades all the way back down into value. The early adopters, right, the high of value. It increases your risk, but still gives you the opportunity to enjoy the sale for a longer period of time. If you sold it down here early in the session, you were the selling laggard. You were the last one to the party to try and short this thing, and you didn't get much of an opportunity to enjoy that sale. You can look at it the same way in a directional move, but you only get a very short period of time to be an innovator in a directional move. You may have the opportunity several times to be the innovator on the buyer on the low here and the innovator seller on the high here. But when we go directional, our innovators are the first ones that buy it down here at the bottom. Early adopters can still profit, of course. Early majority, you increase your risk. You also may crush some of your potential profit target. The late majority, don't even think about it. Many of you have heard me say, I really don't like to trade the point of control, and your laggards would be the last ones to the party to buy it up here. Who do you think the laggards are? You think it's the professional traders? Do you think maybe it's retail traders, the FOMO traders? It's the 90% that are never going to make any money. Be an innovator. Don't be a laggard. There's different day types when it comes through to the market profile. There's the non-trend day, normal trend, neutral center, normal, extreme, double distribution, trend day. Let's take a look at a few of them. Well, I didn't get to those. I don't have those. I do apologize. A non-trend day is usually going to be a day before a holiday or a holiday day. A non-trend day is a day you probably don't want to trade. I would say that Monday, July the 4th, would be a good representation of that. Here it is. Non-trend day. Barely trades outside of the initial balance. It's a very narrow range with little opportunity. Okay, then there's a normal day. We saw one of those in the NASDAQ of all places 2 days ago. Where is it? I'm not seeing it. I may have something wrong here, but hang on.
Oh, I think that's NG, not NQ.
Oh, I'm sorry. Yeah, that's right. That's the natural gas. Look at these old eyes of mine. Thanks, Jack.
That's what I'm here for.
This was Tuesday, Wednesday, Thursday. This was Tuesday. The initial balance is represented by this pale blue line right here. Friday, excuse me, on Tuesday, Wednesday, Monday, Tuesday. What day is today? Wednesday. Yes. On Monday, the entire day session range never exceeded the initial balance, which is the first hour of trade. This is called a normal trading day, but it's not normal. We don't see them very often. It's more like seeing a unicorn. Okay, so now we get yesterday would be more of a normal variation day. The market ranges and then extends. I guess this is today. Another normal variation day where we extend outside the initial balance, but there's no real directional move to it. A neutral center, which is a day like this, where the market has traded outside of the initial balance, but puts forth a very even bell curve. A normal extreme would be similar, but the point of control would be at one extreme or another. A normal extreme day is a day that you may find a long liquidation day where you'll have a B-shaped profile that usually are going to be normal extreme day, and a short covering rally is going to be a normal extreme day with a P shape to it. Now, all of this stuff is in the books. There's just so many nuances and so much information about it. We could talk about it for weeks, but it's been so important to my ability to maintain my presence in futures and my ability to stay and do this. I think it's very important for everybody. The double distribution trend day, I'm sure we can find one of those. Well, we sort of have one today. The market opens and balances in a specific area. Then there is a change where we leave excess right here. These single TPOs would be considered excess, and then we create a balance in another area. This would also be a double distribution trend day because we have an area of time spent here, a move away from that, and a beginning of another area of balance here. In a trend day, true trend days are kind of hard to find. I would call this day here the 7th. The market opens, leaves the open, continues to push higher, continues to push higher, continues to push higher, continues to push higher and then finally closes near the end of the session. We all know what a trend day is, but this is what it looks like in profile. They're usually no wider than 4 TPOs wide. If there's no single TPOs in them, that actually makes them even stronger. And we finished the day up at the high. So the trend day would be that imbalanced day. It is the market's job to facilitate trade. The market is always seeking equilibrium where buyers and sellers can operate and trade freely. The perception of value is what drives that price. When the perception of value changes, The market goes to seek that equilibrium where trade is easily facilitated. It's price discovery. Here we've got what we call a poor high. You can see C period ceased here. D period came up and went one tick above C period. This is a situation where the market either got too long to continue, or a situation where buyers were willing to take that next step, but weren't quite ready to commit. I look at it like this. There's a bunch of kids standing around a pool deciding whether the pool is, if they think the pool is warm enough to jump into. One of the kids sticks his toe in the water, says, nah, it still feels cold. Let's come back later. And this would just be another example of an anomaly, something that sticks out, something that isn't smooth in the profile. So there's so much information. There's so much I want to be able to tell you and to show you, but we're going to have to do that over time. So when we think about the market, always be thinking, okay, what is the market attempting to do? Is the market ranging? Then it's really not attempting to do much, but we have to know that. And if the market is ranging, how good of a job is it doing in range? Are we putting up even highs and even lows, or even in some sort of a formation like a pennant or a rising triangle or a falling triangle? How good of a job is the market doing staying in that? If the market is directional, you got to be asking yourself again, the market is attempting to go higher. How good of a job is it doing getting there? We've talked about how price is validated through time. The price is the advertising mechanism, and volume is the driver of that advertising mechanism. Value is always something that we should consider when you open the market. Is value higher or is value lower? And what's it going to take to move value away from where it is right now? Volume, open interest, very important to look at together, especially when we're thinking about how good of a job is the market doing getting where it's trying to go. The market's directional and volume or open interest begins to fall off. That's a sign that says, okay, this auction may be getting a little bit tired. Maybe we should start looking at maybe starting to sell some strength, or at least looking for the opportunity to find structure to lean against in the opposite direction. I never want to jump in front of a directional trade, a directional market. I'm not that good at finding the turns. I need some sort of structure. And then there's always, how good of a job is it doing getting there? Is it the market showing confidence? A market that leaves anomalies, poor highs and poor lows, is not showing confidence. What kind of conviction, what kind of direction, what kind of momentum is the market exhibiting? All of these things should be considered when putting together your hypothesis for the trading day. And through that hypothesis, you can develop the correct strategy with which to trade that market once one of those hypotheses begins to ring true. And to me, the market profile tells me things in real time, not a lagging indicator. Not always does it tell me things in real time. Not always does it tell me anything that important. But we've only looked at a few of the nuances, day types, and some of the thoughts about the market profile. Now it's time to digest, learn, and start to create those secondary functions where you can look at a profile and you don't have to think, okay, what are the nuances here? Okay, I see this, I see this, I see this. You're going to look at a profile and you're going to be a lot faster into saying, okay, I see what's going on here. I've seen it before. It doesn't mean that I'm going to automatically have a successful trade, but it's going to help me in my confidence in getting into trades. The first thing that I found in learning about the market profiles is my trade location got much better. I stopped fooling around in areas where my reward over risk was basically even. Anywhere near a point of control on a range day, your risk and your reward are equal. I don't want to trade those. I'm always looking for the asymmetric opportunities and noticing previous areas of excess, noticing when the market comes to previous areas to previous naked points of control. Those can be really good opportunities to take profits or even look for an opportunity to enter into a trade. Okay, what do we got as far as questions are concerned? Probably a few, I hope.
Yeah, as a matter of fact, we do have a few going on here. Well, first, Alan just throws right in here. Can you share one or two recent trades taken based on market profile? How large a stop loss is used on a 30-minute
Okay.
time trade? Or just if you just go through maybe a
Okay. Well,
recent trade or
here,
two.
just today. NASDAQ. S&P. This is the S&P, right, Jack?
Yes, it is.
Okay. So we opened with a gap. The market looked above the opening range, looked below the opening range. When I look at this, we're getting pretty cheap. We're range bound. So my hypothesis is anytime we get close to the lower extreme of balance, I'm a buyer until proven wrong. So when we open, we look higher, we don't close the gap. We look lower, where do we go? A period comes all the way down relatively close to to last week's low. Relatively, it's about 10 points, about 8 or 9 points away from it, but it rejects. Okay. B period opens up. Here it is. Okay. This is before the open. B period opens up, trades, and can't take out the low of A period. Okay. I'm going to use this platform. This is T4 because I think it's a little bit easier to see in this regard. Here's the opening range, a big opening range. The market looks higher, does not go to close the gap, looks lower. B period, the second period, opens up and trades back into the opening range, can't take out the low of the opening range, can't take out the low of A. So this was, I would consider, a relatively cheap opportunity for the volatility that is currently in the market at this time. So if I'm going to be buying, let's say, the opening tick, 65.5. Okay, my stop maybe could be just the other side of the opening range. My stop was beyond the low of the day. Dangerous. I don't usually trade this way. However, with the information I had, the open, well, the 730 CPI number came out and knocked us lower. Couldn't take us all the way to the low of last week's range, and showed signs of rejection. 8 o'clock bar, inside bar, 8:30 bar. Doesn't even get to this naked point of control. B period comes down, offers me a relatively cheap opportunity for the opportunity that I believe is in front of me with a move back to close the gap. The only reason I took that is because we are cheap in history. Okay, these are 30-minute charts. We're cheap in history. Oh, it looks like we did get to this. We did get that. We just came and down and checked that naked point of control right here. That line was off a little bit. Looks like we ticked right to it. And then the next opportunity we had to try and take that long, it offered it cheap enough for me to, again, look at that as an asymmetric opportunity. I'm going to be risking 5-6 points, but if it holds, I'm going to be, sitting pretty with, a 30-point move to the upside. I'll risk 6 points, 7 points, 8 points for a 30-point move.
Good point, Hoag. One question from earlier I wrote down. We'll go back to the gaps really quick, and then there's more questions about market profile. Why is it better to trade in the direction of the gap when overnight volume is usually short time frame, weak hands? Wouldn't they usually be too short if they were short enough to create a gap?
Yes. If they can't close the gap, if the market opens and the gap can't be closed relatively early, that means that either our shorter hands traders aren't as short as we think they are, or they've fished out some longer time frame sellers that are just kind of scooping up and keeping the market from closing the gap. It's a great question, though.
Good point there. Going back to some stuff on profile. Let me take a look here. What's the difference between weak versus excess? Can you briefly explain what you mean when you say island reversals?
Island reversals. Wow. Okay. Yeah, sure. Let's see. Use this and see if we can't find a good idea. Oh, well, here. This A period move down here pushed lower. It was viewed as too cheap. Sellers wouldn't push it anymore. Buyers came in and pushed price higher. B period opened. The sellers would not push down below this A period. This is excess. This is a buying tail. B period continues to push higher. Doesn't take out the high of A, but C period doesn't take out the low of B, not even close, and takes out the high of B and A and drives higher. So the fact that this excess down here remains, this is a buying tail. This is an area where price got too cheap for sellers to continue to push into it. Buyers took over and pushed price quickly away from it. You did not have a lot of time to try and get an execution down here. TPO, time price opportunity. You didn't get a lot of time to get an execution down here. You got a lot of time to get an execution in this whole area. Okay, so now we're going to focus on extremes for weak highs and weak lows. Okay, this is a 2-tick excess. It was enough to show us that the auction to the upside had completed and the market moved lower. So I'm going to try and find a weak. That's weak. Okay, A period, and then F period comes all the way back down and trades within a tick. There's no excess here. This is an unfinished downside auction. This is a finished upside auction. We get 3 TPOs. That's enough to create excess, which also actually was created inside a previous area of excess. Price was higher. We drove lower. This single line of TPOs represents excess above price. We ended up back in this excess, and we again left excess above price. We put in the week low. The next day, we open and drive lower. Buying tail. The market turns around, takes out the open, comes back up through the unfinished downside auction here, but we finished that downside auction down here. Now we're free to continue to auction higher until we find some sort of excess to the upside. We've got M period. We've got a late spike. We didn't open in. So the market looks lower, rotates higher, puts up another possible late spike. This time we opened in it. We looked higher. and another late spike, and an opening range at the low of the session. We continue to push higher. Excess. It almost looks like this auction process is tiring as we overlap to higher value and range. While we were really accelerating to the upside, we started leaving excess at the highs. I hope that clears things up just a little bit.
Yeah, I also had JD put in, we have free group coaching sessions. Hoag, which days are those on again?
They are on Mondays and Wednesdays at 1 p.m. Central.
Yeah, so some of these more nuanced questions about the profile you might want to do there. I'll mention that again. That's in the chat. Andy has a question that I can answer really quick. Is your stop loss static or dynamic? Also, are your stop losses at least 2-to-1 reward to risk ratio? We're going to talk all about that. That's like the topic for tomorrow. We'll talk about static versus dynamic stop losses. They definitely have their pros and cons, and it's once again just another variable in your strategy. They can both work. I know Hoag's you like the static ones, right?
No.
Oh,
no, I'm dynamic. I believe that stops have to be dynamic. Because every opportunity is different in its size and scope of risk versus reward.
Oh, I was misunderstanding static versus dynamic. I was thinking of in terms of not that you change it for each trade, but that you move it once you set it.
Oh yeah, well, no. And once I set it, let's say I'm in a situation where I believe I need 8 points of risk. If my default on my OCO is 6, I'll set the trade. As soon as it executes, I'll move the stop to 8 points.
Great. Yeah, and we'll go way into that tomorrow. Let me see if there's a few other. Is there a way to determine if the initial balance is wide/large or small?
It's the first hour of trade. So most platforms that have the market profile will represent that one way or another. So on TS Trader or Tradeovate, the initial balance is this light blue line to the left of the profile. So the initial balance goes from here to here. And then you can see where it gets a little bit darker. That shows extensions of the initial balance. When by the time you get up here, that's 2 times the initial balance. It's a really good and a really important question, because here's the extension below. Maybe it's a little easier to see. This is double the initial balance. This is 3 times the initial balance. And it's an important question because the wider the initial balance, the more energy it's going to take to extend outside of it. Think of the initial balance, a narrow initial balance, as a lamp. It's pretty easy to knock over a lamp. A wide initial balance, think of it as the base of a pyramid. It's pretty hard to knock over a pyramid.
That is true. They've been around a long time.
Yes, they have.
Yeah, like the sixth, one of the top 10 biggest pyramids in the world is a Bass Pro Shop in Memphis. True story.
Really?
Yeah. Yeah, there's a couple of just specific questions. Someone's asking if you mind looking at the ES profile to see what the top of the profile tells us. This might be a good thing for like Make Hoag Money, but if you want to go there quick, I can, while you're doing that, Andy, ask another thing to use the market profile for every trading entry in Exit Hoag.
Absolutely. I can't do anything unless I can get a look at the profile. It makes me feel like I'm on a bicycle and I need training wheels.
Yeah. So Evan says that the join group button on the group coaching page. Oh, are we having that Zoom problem again? Yeah. We may need you to generate a new Zoom for group coaching. and we'll put that up there today. This has never been happening before, and then just recently that started with us. There's something they've changed with like the Zoom registration or something like that.
Strange.
Okay, well, we'll get that set by tonight. So tomorrow we'll share that link again, and then we'll have group coaching next week. That's all I guess we have for today, Hoag. So I'll let you take it home. A reminder: tomorrow we'll be covering trade management, so all the things involving stops and profit targets and moving around stops and all that good stuff, plus a little bit of psychology. So Hoag, that's it for me.
All right. Well, thank you, everybody, and consider adding the market profile to your tools. It doesn't step on any of your other indicators or anything like that. As a matter of fact, when you find an indicator lining up with a feature of the market profile, those are unrelated studies and you're getting the same signal from them, those can be some of your more powerful opportunities. I hope you enjoyed this session today. I know I did. I always enjoy talking to traders about trading, especially about the market profile. And if you do have more questions, we'll get this group coaching thing figured out. And I look forward to spending time as much as we can in those group coaching sessions. So blessings, everybody. Trade well. Watch out today. We got a little volatility, a few things going on. And I look forward to seeing you again tomorrow or on the recap today. Have a great day.